Hello and welcome to this mini-series of videos where we are bringing people with experience in different sectors, investing in different ways, and we are having a general chat about their sector and what they do, what they bring to the table with property and investment. So I'm very fortunate to be joined today by Graeme, who's going to introduce himself very shortly. My name's Stephen Moss from Source Capital. I'm the Managing Director. I've been speaking to different people over the last couple of weeks during lockdown and getting different angles and different views. I've worked with Graeme and his partner for coming up to probably 18 months almost, I would have thought, 12, 18 months. And the things that Graeme has done with property are, that it's kind of an endless list really, Graeme. We've just actually been talking about how do I introduce Graeme, how do I give him a title? And I think he'd have the world's longest business card if I actually give you the full title of everything you cover. But we're going to stick with property investor and developer. And Graeme, if you'd like to introduce yourself to everybody watching, please.
Yeah, certainly. Welcome to everyone. So I'm currently a property investor and developer, although my origins are quite different to that. I started in the IT industry, so very technical person by background. Spent 33 years working for big American IT corporations. And in the last 15 years, predominantly on the business side, particularly around sales operations and business development.
I think in any successful business, there's always a partnership with different skills, and your skills are, I think it's fair to say, like you say, the technical side and particularly the due diligence. And that's one thing that I wanted to kind of get across in this short interview in terms of your experience and your process and your thoughts with due diligence and how you approach it. So we're both in lockdown now currently. One of the questions we get asked, and we've been asked on other webinars, is can due diligence be completed during lockdown, or are we better wait until the end? And, what are your thoughts on that?
Well, the short answer is yes. And the reasoning behind that is just the amount of information that's available online in today's world. So therefore, it's not really a function of lockdown. The ability to do due diligence remotely and in isolation has always been there. It's something that is often even my preferred approach. So the data is there. You just have to go find it. And one of the things I'm always very conscious of is that when people traveling around, when you look at travel, it's a very costly exercise, both in terms of time and money. And I've often found you can get to the information and get to what you need far faster than traveling around.
Well, it's interesting you say that straight away, Graeme, because the biggest thing, exactly what we're doing now, is Zoom. And, that has kind of changed most businesses' structures for meetings, because we've always been the same in terms of we've always wanted to meet investors face-to-face or potential franchisees. Yet we're still doing the same business, but we're doing it on Zoom, and you're getting so many more appointments in, and it's utilising that technology, really. So, I suppose it's a great kind of supporting what you're saying.
Yeah, it is, and it doesn't come as a surprise to me. My last job, I was aligned to 117 countries with 600 people, and we were, just by that nature, using the technology that we're using right now. So for some people in some industries, it's been a way of working for many years.
Well, yeah, I mean, you're covering that sort of distance, yeah, that's amazing. And in terms of the due diligence now, while we're in lockdown, are there any areas that you have found a little bit more difficult? Because not every single aspect can be done online. So are there certain challenges that you come across, and how have you actually gotten around them and dealing with them?
Yes, I mean, the one standout area that I find is rental prices. Just trying to get to reliable, sufficiently accurate rental prices is significant. So that's not unique to the lockdown. It's there anyway. And the reason I bring that one out is I think single let rentals is a particularly low margin business now, partly because of government policy changes around income tax policies. And therefore there's a sensitivity around rental in comparison to deals that I think people need to be more conscious of and more diligent with before going ahead on anything. I guess the other area is also just when you need to physically go and see something. That you are then restricted around lockdown. However, I use Google Street Maps. Google Street Maps is an incredibly useful thing. I'm doing virtual walkarounds of different places, and you'd be amazed how much you can see just using the technology.
I suppose the other benefit as well, we've actually done a couple of virtual viewings where we've been the ones walking around with the camera showing, in an empty property. And the feedback we've had from that is actually, it was good because we recorded it and then watched it again, and things that you'd normally glance over or forget, or, it's there, isn't it? So you can watch it 2-3 times and you actually digest more information. The only thing that you kind of missing is that smell of damp, or that, those extra senses that you need as a property investor. That, or the cover-ups where the rug's over the hole, the hole in the floor and things like that. But it's probably 99%. And I know some offers for some investors that I've been dealing with, they've offered subject to, they've put a deposit down, they've done this, subject to actually just going in once the lockdown's lifted. But everything else they're happy with, and it's kind of that sanity that they walk in and all 4 walls are okay and it's safe and secure. You mentioned about the rental prices. I previous to Source, that I worked in like an online portal for property, and that was one of the hardest things we had was getting the rental data, because it's a difficult thing to do, certainly to sort of average in areas, because you can have such big differences, from one street to another, and there's a lot less data. So how do you actually get around it then, that being a potential problem? Is there any systems, or is there a rule of thumb that you've kind of come up with?
Yeah, I mean, you can use correlation. Once you know what property prices are based on the area, then within a range, you can do some estimation of what rental property prices are. I mean, you can see the asking prices, getting to those in I'll say an unstructured way, quite simply going on to the most commonly used websites and putting in the search criteria. So you can build up a mathematical model that you can then use an algorithm to translate from sold prices back to rental prices. So you can get it within a range, but because of the sensitivity on the low margin, it's just something to be very, very careful with.
I know I've heard of companies that are now starting to do using your rental data as like helping you build your credit file. So I imagine if that continues to grow, and if it can almost become second nature, then that will lead to a better source of rental data as well. So hopefully something that's going to develop over the years, and we'll all be able to benefit from if it goes well. So in terms of due diligence systems and tools, is there any systems that you've created or new tools that you've discovered that you are utilising now, but you actually continue to use them because you found actually really helpful, or they're saving you more time, etc.?
Yes, well, I developed the tools myself, and it's partly just down to my background. I mean, I come from the maths, engineering, computing background. Therefore, just in terms of having that knowledge in my head and being able to use the computer, I'll sit there and design it myself, which doesn't take too long. I haven't found anything out there that's just ready to use and good enough. So yeah, maybe that's my opportunity in the future to go do that.
There's a gap in the market there.
There's a gap in the market for me there. Who knows? However, I haven't looked overly hard because I just know I can do it myself. One of the things I do like to do is use what's called normalisation metrics, so that you can compare property investments to other investments. So one of the things that we do personally and in our business is look very carefully that given any investment, what else could be done with it, which then comes back to the single let situation I described earlier, with those being relatively low returns, especially in comparison with some things you do, Stephen, with your ISAs. You look at the returns on the ISAs, or if you look at the returns on HMOs, which we've been doing, they're far better than, say, single let properties. So I always like to be able to compare what to invest in, both within property related areas and others as well. So it's a way of being able to balance our risk across a number of asset classes.
And is that something that you track as well, or it's just something you review? Yeah. Oh, fantastic. No. That's a really good idea. I mean, that's kind of taking diversification to a whole new level, isn't it, really? If you're able to create a tool that you can plug your different investments into and see the returns that you're getting from it, that's absolutely fantastic.
Yeah, definitely. The whole sort of plan versus actual reconciliation is something that we do. Partly from my sort of previous business experience, we were just doing that as part of our day-to-day business practices, all around sales targeting and forecasting and sales achievement. So a lot of the practices that I'm using come from that. One other thing to sort of add to the due diligence, whilst we're talking about some of the systematic side of things, the numerical side of things, it's always be very aware of the human behavior element. I spent quite some time trying to get my mind around why a sales organization I was looking after just seemed to be unable to meet forecasts or do what they could do. So the predictability was low. And in that research, I came across a couple of things, one on optimism bias, and the other one's on human ability to perceive things. So for anyone out there who likes watching TED Talks, there's a couple of really good TED Talks out there. One person called Tali Sharrow, another one's a guy called Alan Smith. Very, very interesting. I was battling millions of years of human evolution on this one. Humans have genetically evolved to be optimistic on anything they desire. And I think, probably for folks out there in this market, if you look at some of the TV programs like Grand Designs or Homes Under the Hammer, especially Grand Designs, how many people manage to get that property done on time and under budget?
Oh yeah, it's very difficult. Yeah, definitely.
Very difficult. And you think it was why is that? And you can come up with all sorts of technical reasons, but ultimately it's the human optimism bias. So
I blame builders, but yeah, we'll go with what you say. Yeah. I'm sorry for any builders watching, but it's definitely your fault. Just from experience. But that's really interesting. Yeah. So you're kind of looking at people, and you do see it constantly on Homes Under the Hammer where they'll suggest, it's a full refurb, and systematically in their head they're thinking that one trade's going to be straight in after the other. So therefore we only need people. It's going to take us 8 weeks. And in reality, you get one trade, then someone has to order something else. That trade got, and the reality, I suppose, is very different, isn't it?
Well, it is, but in itself, that's the example of the optimism bias in play. But with your knowledge of the industry, say, characteristics, then some people then choose to ignore that when it comes to the early stage of a project. It's like, it'll be okay this time, or to use a phrase from one of our Manchester painters, I'll smash it. And ever get smashed. And I quite like that. But however, as the person who has the responsibility and accountability for those projects, that behavior is known. It's not a surprise, and therefore don't become overtly optimistic because you'd like it to be different to the way it really is.
Yeah. I mean, I think from when we look at loans in terms of giving borrowers and developers loans, we always make sure that when we're suggesting, if they're looking at an 8-month loan, the reality of it is it's going to be 10 or it's going to be 12 months. Let's be sensible with it and build that. It's a contingency, I suppose, isn't it, more than anything else in that respect?
Yes.
Having that aligned.
Yeah, definitely. Yeah, and I think then looking at what are the consequences of being overly optimistic. If you've got some contingency in your finances or contingency on time, then you can live with it. If you don't, I think the consequences can be quite high, and it's all based on a little piece of optimism right at the beginning. So therefore, it is avoidable.
That's really interesting. Because yesterday, I had a chat with another investor. One of the many videos that we've been doing, and that was all about actually when things go wrong. And what I took away from it, and what a lot of comments that I had back were that actually, if you put all the time and effort and energy into the very beginning, things a lot less likely to go wrong there. So, rather than just think, we'll fix that as we go along and things like that, it's about getting all your ducks lined up and then obviously seeing it through from there. So it kind of echoes really what they're.
No, I agree. A phrase I often use is that there's no such thing as an accident, just lack of anticipation.
Yeah. I'll have to get that one on the office wall. So just as they walk in. Definitely. Fantastic. So we were talking earlier about an investor that works with invests with ourselves, Andrew Singer. And the reason we mentioned Andrew is because he's just released a book about, I suppose, to some respect, the due diligence that he does when he's looking at loans. And as I mentioned at the beginning, he never kind of created this to create a book. It was more a case of this is the process he's learned and he's put it together. And actually it's become such a handy go-to list that he started to share it and help other people. Do you have a kind of due diligence checklist, or do you rely more on sort of tech to go through that and numbers and data, or is there a manual list that you do, or is it just a case of you analyze each deal as it comes in?
No, I've got our system. So I have a template with all the checklist items on it. but then we analyze each deal against the checklist. There will be some cases where some additional items might go onto it, but it's a very kind of highly analytical and logical approach. That's something I take to it, and not allowing that optimism bias to creep in. Being really very realistic about any estimates that are there, or whether it's in terms of what the price increase in the future on the property is going to be, or what the likely refurb or build cost is going to be. So I think being honest with yourself on estimation is probably one of the key things.
Yeah, I think another thing I'd add to that, Graeme, is something you probably automatically do without even being aware. But I meet a lot of investors that have invested into deals externally, usually on a joint venture basis. There's no kind of structured or regulated company involved, and it's usually on a JV basis. And what they've done is they've turned around and they can't understand how the deal's not worked, because they've taken all the information that the developers or partners given them, they've stuck it into their calculator, they've analysed that, and they've said, yeah, that's, it works, it's very profitable, it's this. But what they've not done is they've not double checked all those data points.
Yeah.
So they've not actually turned around and say, well, okay, is the growth this? Is the rental figure this? Is it likely to be resold at this? And it's double checking then every single point, that not just relying on that information that you've been given. I think that's, and you probably automatically do that without even considering that, I suppose.
No, I'm very conscious of it. It actually comes back to the TED talk that I mentioned about Alan Smith and human perception. People will give you opinion, and another of my favorite phrases is why do you think that? Whenever someone gives you a value or a figure, to get the insight and what lies behind it, because very often the perception is not there. I mean, just as an example, people have been saying, the property market's been slowing up. Been saying that for the last year. Now, if you look at Greater Manchester, I've been doing some analytics on that just recently in the context of potentially looking for another deal. And yes, the number of sales have gone down, but the prices are continuing to go up. Now, this was prior to the virus situation, so who knows what happens next. But prior to that, if someone says that the market is going down, people will start thinking the prices are going down. However, if you look at the prices for residential property in Greater Manchester, they've continued to go up throughout 2019.
Right, fantastic. And that kind of leads me on to my last question in terms of, what is your view on the market and recovery, short to medium term base? What do you think will happen, and where do you think we'll be?
Yeah, well, if I had the answer to that question, that would be a great.
I kind of have the lottery numbers.
Yeah. I'm trying to find my lucky rabbit's foot right now. Who knows? I mean, the thing that I think has gone up considerably is predictability. However, I think predictability was already in decline prior to the virus coming along. So if you look at 2019 in particular, particularly the last 6 months of 2019, I think a mixture of Brexit and also the USA-China trade tensions were already causing some concerns in the market. I often read the FT.com website, and there's all the messages throughout the last 6 months of last year where, be careful, people are getting unnerved in the market. Now, so one of the things that we do, both personally and business, is manage our net asset value and cash flow. I think that's probably just anyone who's a business person out there, an accountant, would say, that's a statement of the obvious. However, I know many people who neglect either one or both of them.
There's not many that do that at all.
Yeah. So that's what we do. Both personally and as a business. If you look back in time, and if you look at the financial markets in terms of what's happened over the last 4 to 6 weeks, very, very similar in terms of outcome to what happened in the year 2000 and in 2008. So the root causes are very different. So 2000 was the dot-com implosion, and 2018 was a global financial crisis. But the reduction in the net asset value and very likely cash flows of businesses and people are very similar across those three events. The speed of the virus downturn is faster than the previous two, but not hugely. Now, you think, okay, so if they were similar in terms of outcome, although the reasons were different, how long did it take for the markets to recover from the low points on those prior two events? And the answer is 7 years in both cases. So the very literal answer to my prediction is 7 years.
Yeah, right. I mean, I don't know whether, and this is something I come across quite often in terms of, I'm generally a positive person, and I've been through obviously the 2008 recession. I was dealing with property at the time, and I understand. For me, I made business mistakes then because I kind of held on. It was the first recession I've ever entered or been through, and held on to everything as long as I could, and then realised, right, we need to reduce things and cut back, etc. We acted a lot quicker as a business now. But speaking to different people seem to have different statistics or looking at the market in a different view. And I did a short interview with Russell Quirk. Russell is a very knowledgeable, experienced property geek. I'm sure he won't mind me saying. But and his view is that a 12-month recovery, or certainly within that period. So and he's analysing it using figures, stats, history, etc. So I think people look at different stats and different figures, and there's cautiousness as well to take into account, isn't there, to make sure that I suppose the key thing to this position that we're in right now is we haven't seen the bottom, so we don't know when the recovery is going to officially start. We've not even started to get out of our houses yet, so that's going to have a big effect as well, isn't it?
Yeah, it definitely will. Yeah, I mean, I guess the thing that probably is unique to this situation is some of the specifics around the property market. Yeah, that you can't go view a property. The last two instances I spoke about, you could still do that. So there are some variances in there. However, I think there'll be some really great opportunities right now for anyone who is looking to do property acquisition.
Yeah, absolutely. I was talking to a gentleman this morning, and we were discussing Blackstone. So Blackstone are very, one of the largest investment companies in the world. They've just raised £10 billion to purchase repossessed or quick sale property. So across the UK and USA. So they're obviously seeing it as an opportunity, and I think the more savvy and experienced investors are certainly saying, well, there's going to be a lot of good opportunities out there, particularly as well with commercial units. If businesses continue to struggle, there might be more opportunities there. So I'm sure only time will tell. But what would be good is, if in 3 months or 6 months, if we could have a catch up again and just kind of reflect on what we've spoke about now and where we are then at that time. Because I do find it really interesting. You've got a huge amount of experience in it as well, Graeme. So I'd like to thank you for your time and jumping on this call with us. And as I say, hopefully in 3 to 6 months, as long as the world's not ended, we'll be able to jump back on a call and take it from there.
No, thanks, Steve. Good talking to you.
No. Thank you everyone for watching, and please keep an eye out for our mini videos. We'll be posting throughout the whole lockdown of different people, different experience in and around the property sector. Thank you very much. Take care.